effects on the global economy have been unprecedented and indeed severe. These include significant stock market crashes, exchange rate volatilities, rising corporate and public debt, rising levels of unemployment, tightening financial conditions, capital flow reversals, and negative shocks to commodity prices, to mention a few. Under this period of economic crisis, the committee assessed the developments in the global and domestic economic environments in the first 5 months of 2020 and the outlook for the rest of the year. 10 members of the committee were in attendance. The global economic development. The committee reviewed developments in the global economy, noting the swift and widespread monetary and fiscal stimulus responses to mitigate the economic crisis and avoid economic recession. They observed that since the duration of the pandemic is unknown, forecasts for global growth projection for 2020 differs amongst institutions and central banks. While the International Monetary Fund output growth forecast for 2020 was downgraded to contract by 3% in 2020, compared with an initial growth projection of 3.3%, the forecast by the Organization of Economic Cooperation and Development showed a moderation in global output from 2.9% in 2019 to 2.4% in 2020 and 3.3% in 2021. Most central banks in emerging and developing economies have mixed forecasts for their economies, reflecting the intensity of the demand and supply shocks, as well as the effectiveness of the mitigating measures and stimulus by their monetary and fiscal authorities. The MPC also noted that inflation in most advanced economies remained largely below their 2% long-run targets. This was partly due to suppressed aggregate demand, occasioned by lockdown with restrictions on movements and economic activities, with resulting low expectations of future income, forced spending directed only to essential goods and services. The committee, however, noted that although recent monetary decisions in most advanced economies had been accommodative, portfolio flow reversals from emerging and developing economies had continued, indicating general rebalancing of portfolios towards cash and gold as safe assets by investors. This development has resulted in renewed pressure on exchange rates of some emerging and developing economies, with a likely pass-through to their domestic prices. In addition, a likely medium-term impact of these synchronized liquidity injections and other forms of monetary accommodations is the compounding of the already huge global corporate and public debt portfolios, which may result in a spike in global debt post-COVID 2019. Domestic economic development. Available output data from the National Bureau of Statistics (NBS) showed that real gross domestic product grew by 1.87% during the first quarter of 2020, compared with 2.5 and 2.10% in the preceding and corresponding quarters of 2019, respectively. This was driven largely by 5.06% growth in the oil sector and 1.55% in the non-oil sector. The economy, however, expanded by 2.27% in 2019, the most since 2015, and compared to 1.91% in 2018. The positive but lower growth observed during the first quarter of 2020 is expected to dip slightly on the back of the combined monetary and fiscal stimulus by the monetary and fiscal authorities to ensure that growth at this time is supported to avoid a recession. The manufacturing and non-manufacturing purchasing managers index declined significantly to 42.4 and 25.3 index points respectively in May 2020, compared with 51.1 and 49.2 index points in March 2020. The decline in manufacturing PMI was significant following 36 consecutive months of expansion, while the non-manufacturing PMI contracted for the second consecutive month. The contraction in the manufacturing and non-manufacturing purchasing managers index was attributed to slower growth in production, new orders, employment level, raw materials and input prices. The employment level index for the manufacturing and non-manufacturing PMIs also contracted further to 25.5 and 32.0 index points respectively in May 2020, compared with 47.1 and 47.3 index points in March 2020. Generally, the purchasing managers' activities in May 2020 were largely affected by the lockdowns of the global economy to curtail the spread of COVID-19 pandemic. In the light of the above developments, the Monetary Policy Committee commended the bank's efforts on the recent measures put in place to mitigate the economic impacts of the twin shocks on the Nigerian economy. The committee expressed support for the sustenance of the broad-based stimulus and liquidity facilities being provided to curb the adverse effects of the shocks. Committee also noted with concern the persistent uptick in inflation for the 8th consecutive month, as headline inflation year-on-year rose to 12.34% in April 2020 from 12.26% in March 2020. The uptick largely reflected the increase in both the food and core components, which rose to 15.03 and 9.98% in April 2020 from 14.98 and 9.73% in March 2020, respectively. The MPC noted that the recent increase in inflationary pressure was largely due to a combination of factors, including disruptions in supply chain owing to restrictions on interstate travels, reduced domestic supply of foreign exchange, continued impact of deteriorating domestic infrastructure, and spillover effects of the pandemic on global supplies, amongst others. Against this background, the committee emphasized the need to sustain measures already put in place to maintain price stability. It noted that as the supply of goods and services increased following the gradual easing of the lockdown and return of economic activities, particularly in the informal sectors by which the daily paid workers access daily income, there will be increase in aggregate supply to the economy. On the monetary aggregates, committee noted the marginal growth in broad money M3 to 2.66% in April 2020 from 4.42% in March 2020, largely due to increases in net domestic and foreign assets. The growth in M3 was, however, significantly below the indicative benchmark of 13.09% for 2020. Aggregate net credit also grew significantly by 8.07% in April 2020, compared with 4.90% in March 2020, although this remained below the indicative benchmarks of 16.85% for the year. The committee therefore observed that there was a relative scope for increased money supply to fund economic activities and boost output recovery. In the review period, money market rates remained relatively stable, reflecting the prevailing high liquidity conditions in the banking system. Accordingly, weighted average interbank call and open buyback OBB rates decreased to 7.33 and 5.52% in April from 10.29 and 11.78% in March 2020, respectively. The committee observed that though the equities market was largely bearish in the first quarter of 2020, moderate improvements continued to be recorded since the beginning of the second quarter. Consequently, the oil share index and market capitalization increased by 18.33% apiece between end of March 2020 and May 22, 2020. This bullish trend reflected improved investor sentiments in response to the mitigating measures introduced at the onset of the pandemic by the monetary and fiscal authorities and positive outlook on the global oil market. The MPC expressed confidence that the current monetary and fiscal policy measures would further strengthen investor confidence. The non-performing loans ratio decreased to 6.58% as at the end of April 2020, compared with 10.95% in the corresponding period of 2019, due largely to recoveries, write-offs, and disposals. The development was adjudged by the committee as a sign of reasonable stability in the banking system and urged the bank to maintain its toolkit of prudential and regulatory measures to ensure that NPLs stay below the prudential benchmark of 5%. The outlook. The overall medium-term outlook for the global economy remains broadly uncertain as the COVID-19 pandemic and associated containment measures continue to disrupt normal economic activities across the globe. The global economy remains largely confronted with several headwinds, some of which include weak aggregate demand due to declining consumer and investor confidence, disruption in global supply chains, shock to oil and other commodity prices, continued lull in global financial markets, adverse shocks to global capital flows, as well as rising corporate debt in the advanced economies and public debt in some emerging markets and developing economies. Available data on key macroeconomic variables in the domestic economy indicate that the economy achieved a positive output growth during the first quarter of 2020. The committee noted even if the lag effects of COVID-19 results in a low negative output growth in the second quarter of 2020, it could quickly be reversed to avoid a recession for Nigeria by the third quarter of 2020 based on the far-reaching measures taken by the monetary and fiscal authorities to mitigate the combined effects of the COVID-19 pandemic and oil price shock. Projections by both the IMF and federal government indicate that the economy would contract in 2020 by 3.4%. Given more recent developments, however, CBN staff projections indicate a somewhat less pessimistic range of contractions. This forecast is underlined by the measures to arrest rapid spread of COVID-19, improvement in crude oil prices, which stood at about $34.8 per barrel as at the 28th of May 2020. The moderate recovery in crude oil prices reduced the pressure on external reserves and government revenue. Headwinds to growth, however, remain the legacy issues of the persistent infrastructural and security challenges. The committee's consideration. Central to committee's considerations were the impact of COVID-19 pandemic, the oil price shock and the likely short to medium-term consequences on the Nigerian economy. In particular, committee acknowledged the gradual improvement in macroeconomic variables, particularly the improvement in the equities market, the containment measures of the COVID-19-induced health crisis, as well as the impact of the increase in crude oil on the external reserves. Committee noted the stability in the banking system, shown by the increase in total assets by 18.8% and total deposits by 25.52% year-on-year. The performance of the loan-to-deposit ratio policy, which was introduced in July 2019, showed that total credits increased by 3.1 trillion or 20.45%, with manufacturing, retail, and consumer loans, general commerce, and agriculture as major beneficiaries. The committee recognized that under the 100 billion healthcare sector intervention fund, the bank has approved and disbursed 10.15 billion for some projects for the establishment of advanced diagnostic and health centers and the expansion of some pharmaceutical plants for essential drugs and intravenous fluids. As part of the 500 billion, 1 trillion naira intervention targeted at the agri and manufacturing firms, the bank has further disbursed 93.22 billion naira under the Rural Sector Support Fund to boost local manufacturing and production across critical sectors. This consists of over 44 greenfield and brownfield projects. The bank has also approved 10.9 billion to 14,331 beneficiaries under the 50 billion naira targeted credit facility for households and small and medium enterprises, out of which 4.1 billion naira has been disbursed to 5,868 successful beneficiaries. The committee directed management to reach out to the banks to encourage them to offer and disburse those funds to those priority sectors of the economy so as to stimulate aggregate demand and create more jobs in the country. The MPC have praised the federal government's resolve to maintain the core its spending plans for 2020, as this remained vital for the attainment of the much-needed economic recovery. It also applauded the government's efforts at revising the oil price benchmark downwards to reflect prevailing conditions. It reiterated the urgent need for government to improve tax collections through a gradual but purposeful diversification of the economy's revenue base. The committee also urged government to remain focused on the implementation of the revised 2020 to 2022 medium-term expenditure framework as the basis for sustainable fiscal policy. The MPC emphasized the need for government to work towards a gradual reopening of the economy in line with recommendations of the Presidential Task Force and advice from the medical experts, insisting that efforts must be directed at saving not only lives but also livelihoods. This is to enable the resumption of economic activities necessary to stimulate growth, hasten the pace of recovery, and restore livelihoods, particularly the vulnerable in our society. On prices, the MPC expressed concern about the heightened inflationary pressure attributed to a combination of monetary and structural factors. While price stability remains the bank's primary mandate, the committee expressed the need for a balanced approach in supporting growth in the face of rising domestic prices. With respect to output, committee urged the federal government to continue exploring options of partnership with the private sector to fund investment in infrastructure. This would aid employment generation, support production, and boost output growth. Committee also reiterated the potentials for both direct foreign and domestic investments to support growth in key sectors of our economy, including Nigeria auto manufacturing, aviation and rail industries. Committee expects that on the backdrop of the various stimulus packages, increased credit at lower interest rates, the impact of the COVID-19 pandemic will be relatively less severe than had earlier been expected, and the reversal in growth deceleration would become more optimistic. Committee commended the bank's role in effective oversight of banking system, evidenced by the relative stability in key financial soundness indicators and systemic resilience of the banking sector in the face of severe external shocks. On the choice before the committee, the MPC observed the weakening of the global macroeconomic environment due to the adverse impacts of COVID-19 and drop in crude prices, which has resulted in negative output in most economies. The MPC also feels that the logical expectation is that to ensure that the global economy reverses from the recession timely, what policy makers must do is to take actions that will necessarily stimulate growth and recovery. For Nigeria, although Q1 2020 gross domestic product turned out pleasantly at 1.87% and rates of inflation somewhat moderated, Nigeria may escape a recession if concerted efforts are sustained to stimulate output. Accordingly, on balance on whether to hold, loosen or tighten, the Monetary Policy Committee was of the view that tightening of policy stance is for now inappropriate. This is because tightening will result in further contraction of aggregate demand as disposable income diminishes, leading to decline in output, which is necessary to sustain the supply chain for growth recovery. Tightening will also increase cost of credit and reduce investment and impact negatively on output growth. As regards the option of holding previous policy stance, the Monetary Policy Committee felt that a hold may indicate that the monetary authorities are insensitive to prevailing weak economic conditions. There is therefore the need to signal a direction towards immediate recovery. Monetary Policy Committee also feels that a hold decision may slow down the trajectory of the weakened economy compared with a loosening stance, thereby slackening output growth. On loosening, whereas the Monetary Policy Committee is concerned that excess liquidity engendered by loosening may overshoot the economy's absorptive capacity and accelerate inflationary pressures, it nevertheless feels that, given the slow rate of acceleration of inflation, the accommodative stance will stimulate aggregate demand and supply in the short term. This is because an accommodative stance, through a lowering of policy rate, will stimulate credit expansion to critically important sectors that will also stimulate employment and revive economic activity for quick growth recovery. The MPC noted that if all stimulus packages already announced by the bank, such as concessionary rates, loan restructuring, and targeted loans to agri manufacturing and health sector are well utilized, this will produce the desired impetus needed to boost economic recovery in Nigeria. Committee's decision. After reviewing the three options, the MPC noted that the imperative for monetary policy at the May 2020 meeting was to strike a balance between supporting the recovery of output growth while maintaining stable price development across inflation, the exchange rate, and market interest rates. To this end, committee noted that the cash reserve ratio requirement was recently adjusted upwards as a means of tightening the stance of policy. In its response to COVID-19 pandemic, however, the bank reduced interest rates associated with all CBN interventions from 9 to 5%. Increasing MPR at this stage will thus be counterintuitive and will result in upward pressure on retail market rates. Committee maintained that although a sharp decline in output growth is expected during the second quarter of 2020 and maybe the third quarter, if the current stimulus initiatives are properly implemented, the economy would reverse to positive growth by the fourth quarter. Hence, the optimism on the part of the Monetary Policy Committee that the country may not slide into recession. In view of the foregoing, the committee decided by a unanimous vote to reduce monetary policy rate and to hold all other policy parameters constant. 7 members voted for a reduction of the monetary policy rate by 100 basis points, 2 members by 150 basis points, and 1 member by 200 basis points. In summary, the MPC voted to 1. Reduce MPR to 12.5%, 2. Retain the asymmetric corridor of plus 200 and minus 500 basis points around the MPR. 3. Retain CRR at 27.5%, and 4. Retain the liquidity ratio at 30%. Thank you so much for listening.